Now let's introduce two important concepts: contract asset and contract liabilities. When a seller receives payment prior to recognizing revenues, contract liability will be recognized, and this liability will be called unearned revenue or deferred revenues. Right, for example, magazine subscription, right? We pay before we receive magazines from the publishers. So when the publisher receives our payment, right, that become a liability to us, to customers. It will be recorded as unearned revenue or deferred revenue. Right, for the same logic, when the seller delivered something to customers, okay, before sending the bill for payment to customers, the contract asset will be recognized. Right, for example, right, company A agrees to deliver 300 units to B. 200 units will be delivered today and 100 delivered later. However, the bill or the invoice will be sent at the time of the second delivery, but not for today's delivery. Alright, because company already delivered 200 units, okay, a related contract asset will be recorded. In this case, account receivable will be recorded. Revenue will be booked accordingly. Okay, those are the two important concepts, and we're gonna talk about those and revenue and account receivables very soon. Another related topic is consignment sales. Right? A consignor delivered product or merchandise to consignee. So we can view consignee, for example, auction company, right? We send our stuff to auction company. So the auction company consignee is going to sell merchandise for us. Okay? If this is a sale, now this is not a sale. Okay? So we're going to record no sale until the inventory is sold by the consignee, the auction company. Customers often purchase product or services prior to delivery, so they make payment in advance. In this case, it is an obligation of the selling companies. For example, digital data subscriptions, right, season ticket for baseball, basketball games, those things. So a contract liability will incur in this case, and typically it will be called unearned revenue or deferred revenues, and we have seen that. So how to record these unearned revenue? For example, customer paid $840 for a digital subscription covering 12 months for a whole year. Right? When the company receives payment, debit cash, and a credit a liability called unearned revenue. Now the key is the next step, the adjusting entries. One month later, right? The company has provided 1 month's service, so it's time to recognize the 1 month's revenue from the data subscription. Right, based on the calculations, that's $70 per month for the contract price. So we're going to reduce the liability, debit unearned revenues, and increase the revenue, credit revenues, $70. This is typically how we do to adjust the unearned revenue to revenue. Another examples in which unearned revenue will be considered is bundle sales. Right, in which two or more products or services are sold together. For example, Apple selling the new iPhones for $999. Very likely it's a Pro model, okay, among which just for example, $900 is for the iPhone itself, and the $99 is for services, right, including software services, maintenance, and customer support. But those are sold together in a bundle together. Okay, it's very important the GAAP requires transaction price to be allocated among various performance obligations. If we can have distinct performance obligations, for example, the Apple's software update, software service can be a distinct service. Okay, then that part we're going to allocate a transaction price to that part as well. For example, we can allocate $50 for software services. However, those services Apple will fulfill its obligation in future, not for today. So the $50 can only be recorded as earned revenue. And for the iPhone sale, $950 will be a sales revenue of $50 because Apple has not fulfilled its obligations. That become an unearned revenue. Another example of unearned revenue is gift card sales. Right? There's so many gift cards sold every day, especially by department stores. So it's very important to consider both revenue and unearned revenue for department stores, because gift card sales will be recorded as unearned revenue, right? So, for example, Macy had a promotion, so they attract customers. Revenue for sure will go up, but don't forget unearned revenue, because gift card sales can also rise, and this is going to affect company's profitability. Not necessarily for this period, but related to the promotion event, it's going to increase sales for the near periods, near quarters for sure. Next, accounting for long-term contract. When a company agrees to engage in long-term contract with customers, there are a number of reporting issues that we need to consider. Okay, for example, does a project consist of multiple distinct performance or just one single performance obligations? What is the expected transaction price, and are the performance obligations fulfilled at a time point or over time? If over time, what is the measure of the fulfillment? First, when there's one performance obligations and the performance obligations will be satisfied over time. For example, the construction company signed a $1 million contract to build a new library. Library is a single performance obligation, will be fulfilled over time. Okay, so in this case, the cost incurred, the cost the construction company has incurred reflect the value transfer to the customer. So here we can adopt a cost-to-cost measure of performance over time. Okay, for example, we estimate the total cost is $6 million. We estimate the total cost is $6 million, and in the first year, the construction company incurred $1.8 million. In other words, the company has incurred 30% of the total cost. You can say the value transferred to customer will be 30%. In this case, the revenue, we can recognize 30% of the revenues, or 2.4% recognized in year one. And revenue less cost equals gross profit, $600,000 revenue recognized in year one. Therefore, for the second year, 70% cost incurred, so the 70% revenue transferred to customers, and 70% of the sales will be recorded in year two, $1.6 million. Accordingly, the $1.4 million gross profit recognized for year 2. So this is for when performance obligations, when the obligation satisfied over time. However, it is possible that company determine its performance obligations is not satisfied over time, but rather at a point in time. So the same company signed a 2-year contract, $8 million to build a new library. Okay, the term of the contract requires, right, performance obligations fulfilled at a point in time at completion. And if the project is not completed, not satisfied by the customers, the company will receive nothing. So in this case, obligations is fulfilled to the completion date. So $0 revenue will be recognized in year 1, and $8 million revenues recognized by the end of the year 2. Accordingly, the total cost of $6 million will be reported by the end of year 2. All right, that's how we deal with performance obligation fulfilled at a point in time for long-term contract. Here we have comparisons between the 2 long-term contract method. So overall, for 2 years, the results will be the same. It's the only difference is when the revenues and gross profit recognized between these 2 methods. It is possible that in both contracts, right, there's a customer's payment schedule to the construction company will be the same. Okay? So it depends on how customer pays. If customers pays in advance, for example, according to the contract, customer will pay $3 million for year 1. Okay? In this scenario, fulfilled over time scenario, customer paid $3 million in advance. The $2.4 million will be recognized revenues, and the $600,000 will be reported as unearned revenues, so liabilities. Right? For the same payment, in scenario 2, fulfilled at a point in time, year 1, the whole amount, okay, $3 million will be reported as unearned revenue. If the if there's a payment is lower, for example, if the there's no payment required for the customers. However, in year 1, scenario 1, the company has provided should recognize $2.4 million revenues. Contract asset will incur, that's account receivable. Right? For the same situations, no payment. Scenario 2, fulfilled at a point in time, year 1, right? There's no payment, but there's also no contract asset incurred in year 1. So those are the things we need to consider when we're going to have contract asset, right? The account receivables, and when we have the contract liabilities, the unearned revenues.